Right folks, well the past few weeks have been really tough on the markets. You've probably noticed with everything going on in the US right now, it's completely normal to feel uneasy and perhaps even a little bit anxious.
And for these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations.
You're not alone. We're hearing from people who've always been confident in their investments now questioning if they should change strategy, should they pull out into cash, or should they just wait and see? And the truth is, these are definitely uncertain times and I'm not going to pretend otherwise. Now stick with me as I walk you through what's been happening, explain the reasons behind the recent drops and show you what history suggests might happen next, so you can move forward with more clarity and confidence and maybe breathe a bit of a sigh of relief. Now I'd like to start this video off with a little bit of reassurance for you all. Now we know that markets are forever changing. It's life. They go up and they go down, but history shows that reacting to short-term noise rarely improves long-term outcomes. Periods like this, when emotions are at their peak, are often when the worst investment decisions are made. Whilst no one can predict exactly where the stock market will go in the coming weeks or months, I want to share some valuable information and data that will provide you with a fresh outlook, and hopefully it'll help you regain a sense of perspective. So let's start with a quick breakdown. What are tariffs? That's the word on the street. Well, tariffs are essentially taxes on imports. They're designed to make foreign goods more expensive, giving domestic industries a competitive edge. The idea is to protect local businesses by encouraging consumers to buy more homegrown products. Now, under President Trump, we've seen the introduction of two key types of tariff. The first is the universal tariff. That's a flat 10% tariff applied to all imports except those coming from Canada and Mexico. Then we've got country-specific tariffs. These target around 60 nations, with China facing the highest rate, an effective tariff of 54% on its goods.
So, if you look at that, China, first row, China, 67%. That's tariffs.
Now recently, Trump announced a 90-day pause on most of these tariffs, but with one major exception, China. Tariffs on Chinese goods remain firmly in place. So what impact has all of this had on the markets? Well, the Federal Reserve is watching things very closely right now, as you'd expect. They're holding off on any immediate interest rate changes and they're waiting to see how inflation pans out. Now here at Reeves, we're taking a very similar approach. We're staying cautious, but focused on smart and steady investing. Now that said, the US economy still has strong fundamentals. Consumer spending is solid, private sector balance sheets are in good shape, and productivity has been on the rise. But here's the catch: tariffs often act as a zero-sum game. What that means is for one country to win, another has to lose. And that usually sparks retaliation, the kind that can spiral into larger trade disputes. This is exactly why many countries are hesitant to accept tariffs like these in the first place, and certainly long term, unless of course there are bigger geopolitical factors at play. Now, reflecting on past market downturns, like the 2008 financial crisis, for example, or in 2020 COVID-19, one thing becomes very clear: markets do bounce back. The 2008 crisis, for example, after a steep decline, the S&P 500 index rebounded significantly, showing us just how resilient the general market can be over time. Now, history tells us that whilst markets may go through sharp drops, they often recover with even stronger growth. That's why it's so important to stay invested, folks, even during the tough times. Now, trying to time the market, which is selling during a downturn and waiting for things to settle, well, that can be really risky. And why is that? Well, it's because some of the market's best performing days tend to come right after the worst ones. And now, if you're not in the market during those rebounds, you can miss out on some of the biggest gains. In times of volatility, it might feel safer to move to cash, but doing so can mean missing out on those crucial recovery days that really do drive longer term performance. So what does all this mean for us here in good old Blighty? Well, Chancellor Rachel Reeves, no relation to us, is working with limited fiscal room. That increases the likelihood that we'll see either tax rises, spending cuts, or possibly both in the near future. And at the same time, the Bank of England is expected to start cutting interest rates, and potentially by more than the markets are currently pricing in. So it's completely normal to feel a wee bit uneasy during periods like this. Uncertainty can be uncomfortable. I say can be, it pretty much is uncomfortable, but that's why keeping a long-term perspective is so important. Now, right now, Many sectors, particularly in the US, are still trading below their long-term averages. That suggests that there could still be room for growth. And in times like these, forecasters often take a cautious view, which means we could actually see some upside surprises ahead. There's also potential for fiscal and monetary support across major economies, especially in Europe and Asia. So despite the challenges, there are some optimistic trends emerging. And really, it all comes back to the foundation your portfolio is built on: your goals, your risk tolerance, and your time horizon. That's what helps you stay grounded even when markets feel noisy or unpredictable. So to wrap up, yes, market ups and downs can be tough, but history shows that staying invested, staying diversified, and sticking to a clear plan tends to lead to stronger outcomes over time. This might also be a good moment to put any idle cash to work, review your protection planning, or simply check in with your advisor to make sure your portfolio is not only built for today's environment, but it's also still aligned with the future you're working towards. Now, if this period has left you feeling a wee bit uncertain about your investments or your financial plans generally, and you don't have a financial advisor, you don't have to navigate this world alone. Our team of expert advisors are here to offer tailored, practical guidance. We can help you stay on track, review your portfolio, and make sure your long-term goals remain completely within reach. This is what we do. We help people make clear, confident decisions, even in challenging times such as now. And if you'd like support or just someone to talk it through with, click the link below to book your free, no obligation financial review. It's worth over £800 because we're here when you're ready. Now, to help you get a better understanding how political shifts like this could impact your retirement plans, we recently hosted a webinar that takes a deeper dive into the topic. That includes a live Q&A with common concerns from people just like you. So click the link in the description, get access to the webinar replay. And to make sure you're avoiding some of the most common pitfalls in retirement planning, we've also put together a really helpful video, the 5 biggest mistakes made by retirees. So click here to watch and take the next steps towards a more confident retirement, and I look forward to seeing you there.